Hello and welcome to our market alert video for today, which is Friday, September 20, 2024. And boy, do we have a lot to talk about this week. But before we do, let me introduce myself. I am Ken Moraif. I'm the CEO and founder of Retirement Planners of America. And in case you don't know, we have a singular goal, which is to create as many SCWPS as we possibly can. And if you don't know what SCWPS is the acronym for Second Childhood Without Parental Supervision. So when a client of ours retires, we want them to go play, have fun, enjoy, and don't worry about all this boring financial stuff. Let us do it for you. Your job is to be a SCWPR. And so we got some important data. You know, the 800-pound gorilla in the room, of course, is the Federal Reserve, and they lowered interest rates, by 50 basis points, which is 1% is 100 basis points, so 50 basis points is 0.5%. And this was more than many people anticipated, certainly more than we did. We talked about this last week when we said that we thought the Fed would not go 50. We thought they'd go with the traditional 25 basis points. Why? Because if they're going 50, they're going big. And if they're going big, maybe it's because there's bad news. They need to lower interest rates way more than anticipated so as to compensate for how bad things are. And we felt that they would not want to roil the markets with this kind of thing. And so we thought they would only do 0.25%. Well, we were wrong, but I do have some thoughts about that where in about a couple of months, I think it may turn out that we were actually not wrong. So we'll see. But before we dive into that, I got to tell you a quick thing. My grandson, Nathaniel, who is now 3 years old, just celebrated his third birthday. His parents, all of us, are big believers in politeness and saying thank you and please, all the time, and so as to be polite. And so he has learned that not only is he supposed to say, may I have something, please, and thank you, but he's also learned how to say, no, thank you, no, thank you. So when he's supposed to eat his broccoli, he's like, no, thank you. And it's not thank you with a T, it's thank you, F-A-N-K, thank you. So he's learned how to politely say no, which causes a dilemma. Are we happy that he's being polite when he says no, or are we unhappy that he's not eating his broccoli? I don't know. It's a question of the ages, I think. Anyway, let's talk about the Federal Reserve. So the Federal Reserve did come out and they said, now they have two mandates, the Federal Reserve does. One is to get inflation around 2%, or I should say at 2%. That's their mandate. But the other thing that they have a mandate about is that they must also keep employment at in a good place. And so now the focus that they've told us is they've switched from worrying about inflation because now they feel inflation is coming down and therefore it's going to get to their 2% target, and they're not worried about that so much. Now they're worried more about the employment numbers, which are coming down faster than maybe expected and in fact gathering momentum. And that's a really bad thing because if employment drops through the floor, then we'll have a big bad recession, and that will be terrible, and everybody will be mad at the Federal Reserve. So they now decided that the employment numbers are getting bad so quickly and the momentum is building so rapidly that they needed to go big, not 25 basis points, but 50 basis points. So we thought the market would take that badly, but in the day after, on Thursday, the market actually, the S&P went up almost 2% on the news. Yay, the Fed is lowering interest rate. Well, folks, let me just tell you right now that our view, and you're going to hear it here first, our fearless forecast for the rest of this year is that this move was overdone. And what's going to happen is inflation is just going to start going back up again. And you heard it here first. And what's going to happen when that does is that the critics are going to come out of the woodwork. And you Federal Reserve people, you are incompetent. You are fools. What did you do? You lowered interest rates too much. You're causing inflation. And that's, we think, is what's going to happen. Now, if you watched this video 3 weeks ago, hopefully you did. If you didn't, please find it and do. I had on my director of our investment oversight committee, Jordan Roach, to go over what has happened in the last 10 presidential cycles. And in 8 of them, we had a correction, which is a drop in the market. And we anticipate that this is going to be the case here too. We're going to see inflation start to heat up again. The market is not going to like that. Plus the uncertainties over, who's going to win the elections and what the policy is going to be. And the combination of that, we anticipate, will bring a correction with it. Now, if you watch that video, you'll know what the rest of the story is with regard to how bad they are and how quickly we recover from them. But I'll give you a hint. We're not overly worried about it because we think it'll be a buying opportunity and not necessarily a reason to panic. However, we have to keep our eye on the jobs numbers because that's going to drive us into a recession or have us have what the Fed is looking for, which is a soft landing, as they're calling it. Now, one of the things that because we work with people who are over 50, who are retired or retiring soon, we believe that growth is important, but protection of principal is even more important. And so because of that, even though we do think the market's going to set new all-time highs beyond what they've already done this week, we don't have a crystal ball. We don't know that for sure. And so we want to plan for the worst and hope the best happens, not plan for the best and hope the worst doesn't happen. We think that's not very prudent. So therefore, we always have our invest and protect strategy ready. If you're over 50, we believe you should have a strategy to protect yourself on the downside because bear markets happen. Over the last 100 years, we've had 33 of them. And the average bear market brings with it a 37% drop in the stock market. In Y2K, it was almost 50%. In 2008, it was 57%. So those are bear markets that can significantly change the opportunity for you to retire or stay retired. And we believe having a strategy to address that is paramount. Growth is important, but protection of principal is even more important. So that's what we believe. So right now, our view is that the stock market is probably going to see some rocky period here as the 50 basis point interest rate drop is digested by the market. And maybe it's like, who knows? Maybe that wasn't such a good thing after all. Bonds should do well in this scenario, as we've described in the past. We think that the bond market's going to do very well in the second half of this year, and so far that's exactly what's been happening, and we think that'll continue. So stocks rocky, but surviving a correction. Bonds doing really well heading into the end of the year, but we could be wrong, and we want to protect against the downside if that's the case. So our website is rpoa.com. Please go there, subscribe to this Market Alert video. I encourage you to do that. And we also have a podcast, which I encourage you to listen to as well. And you can find that on our website, rpoa.com. So I hope this video found you healthy, wealthy, and wise. And we'll talk soon.